All right, we are live. Welcome, Jim.
Thanks, Jason. Thanks for having me on.
Absolutely. Everyone who's joining us, we already have a lot of people who are waiting for this video. As you guys can see, the title of the video, will we see another housing market crash like we saw in 2008? The reason why we decided to make this a live stream and make this a video is because I get a lot of comments regarding this is just the beginning. We're going to see the biggest housing market crash we've seen, even bigger than 2008. So I thought that Jim and I can hop on here, answer your questions, but also share some data regarding what we're seeing right now compared to years past. And Jim is a really good person to talk to about this because you've been a loan officer for over 20 years. You were a loan officer back in 06 through 08. And so I think you're going to provide some really good context regarding, what the environment was like on the lending side back then compared to what we're seeing right now.
Sure, absolutely. I've been a loan officer since 2002, so I've seen a lot. But those years, especially, we mentioned that we're going to discuss today, are really crucial years to understand how extreme things can get in a very quick environment change, a big shift. But there's a lot of other fundamental things we'll discuss today that are different than our market today.
Yeah, absolutely. And so, yeah, I think that first of all, too, I hear an echo too, Jim. Do you have your YouTube on by chance?
Nope.
No? Okay. I don't know what's going on there. I don't know if anyone else can hear the echo. Anyways, I just wanted to say that I want to be recognize that a lot of people who may be watching today's video may not be homeowners. You may want to buy a house, but you're seeing your dreams escaping because of increasing prices and rates. And I just want to be cognizant of that because Jim and I have been homeowners for a long period of time. But I do want to recognize those who do want to buy a house because that is the American dream, right? You want to see home prices decrease in order to make your entry into buy a house easier. So I just want to be cognizant of that. I know that Jim and I are in a lucky position being homeowners for so long. But not everyone is in that position. By the way, too, if you guys have any questions, we'll answer some questions here in a little bit, but just put question in caps if you guys want any questions answered. So let me share my screen with you guys. And that would be right here. Just 1 second, please. I'll share my entire screen. Actually, let's do window by window. Sorry. Okay. Can you guys see this existing inventory? You can see that, Jim?
Yes, sir.
All right, cool. So I think I want to talk about the changes we're seeing right now compared to 08, 09 during the Great Recession or Great Recession. So this is a chart I pulled from, I think it was from, what was it? I can't remember this source. My apologies. But the source of this data is the National Association of Realtors. So this chart doesn't go or goes through mid last year, but right now, at least for the month ended in March this year, we have around 1.1 million existing houses for sale. So right around right here, but during 05 through 2011, we had over 3 million houses for sale, and it actually surpassed 4 million back in 2007. So looking at the levels we have right now of inventory, it's far below pre-COVID levels, and of course, far below right before the Great Recession. This is January 1999 through 2005 right here. More or less over 2 million houses for sale. Now we only have 1.1 million. And that's right here, 1.1 million by the end of March, according to NAR. But we're also seeing right now, which is different compared to 05 as well, is the number of foreclosures. So these are foreclosure filings that peaked right around 09 and 2010. We had over 900,000 for each of these quarters. Now we have approximately 100,000. That's based on data from Adam. But I mean, also we have very low delinquency rates of single family mortgages as well. This is according to our good Uncle Fred, and the source here is Fed, or the Fed. And this is for Q4 of 2023, the most recent stats we have from them. The overall delinquency rate for single-family houses is at 1.69%. During the Great Recession, or right after that, it peaked in Q1 of 2010 at 11.5%. So back then, around 11% of all single-family houses were late on paying their mortgages. On top of that, looking at data from NAR, this is based on my own analysis here, from August of 2006 through approximately, when was this? All the way until we hit December of 2009, we saw a decrease in the US median home sold price each and every month, except for 2 months. So we basically had 39 of those 41 months in which home prices overall decreased year over year. That was a recession. What we also are seeing right now, though, let's kind of talk about, I want to make this video not just one-sided, just talking about the difference between right now compared to '08, but also some challenges we're seeing right now. So here's a look at the amount of credit card balances that Americans owe, at least for February this year. And that's a new all-time record high, $1.3 trillion of credit card debt. Look at the Great Recession, though, only around 1 million. So we have all-time record highs for credit card balances. But on top of that, the delinquency rate of credit cards at very high levels as well. In fact, the highest level since Q4 of 2011. That rate at 3.10%, much higher compared to pre-COVID levels at around 2.6, but way lower compared to 2009 when that rate was at 6.8%. Also, what we're seeing right now, there's also a challenge as well. We can kind of talk about this as well. This actually just announced, I think it was yesterday or the day before that, the US personal savings rate at 3.2%, very, very low levels. In fact, of course, much lower compared to when people gain stimulus checks. But going back to the 1960s at 3.2%, way lower compared to the past several years now. We're also seeing right now is that inventory is rising. So we have approximately 32% more houses for sale right now compared to the same time frame 1 year ago. This is from Realtor.com. On top of that, the last slide I want to share with you guys, we'll kind of open up with questions and also talk about what Jim saw in the lending side 10 years ago or 20 years ago compared to now. The average daily rate for a 30-year fix is at 7.51%, excluding just a couple days this month. This is the highest rates we've had going back to mid-November last year. So more or less a 5.5-month high, which is absolutely wild to say the least. Let me stop sharing my screen. So I think I kind of broke down, right now we're seeing a lack of foreclosures. We're seeing inventory far below the past during the Great Recession. But of course, a lot of challenges, all-time record highs for credit card balances, late payments on credit cards. But overall, the delinquency rate of single-family houses or mortgages still at relatively low levels. So anything you want to add to that, Jimbo?
Yeah, absolutely. So a lot of those data points you shared that showed examples from 2009 and 2010 were the effect of some of the causes from the previous 2-3 years of bad mortgages that were created. The subprime marketplace, subprime being below traditional conventional loans, were a lot of the reason why we saw the velocity of that increase in volume, the velocity of the increase of inventory, and the velocity of a decrease in value so quickly, because so many houses came on the market so quickly. And a lot of those loans were not properly vetted for people that had the ability to repay, known as ATR. So a lot of those loans that we saw, if you've watched the movie The Big Short or other movies from that time frame, show examples of people buying homes with either stated or no income, buying not only one house, but 3 or 4 investment properties, and having
at the same time too, right?
at the same time, and having no idea how to do any of these things. So, again, a lot of those companies that did bad loans are no longer in business. I happened to work at a bank at that time. At that time frame, we didn't have some of those loans that other companies had that were offered. So there were a lot of acronyms from those time frames. You had a program called Ninja, no income, no assets, no job. Ninja. Like that was literally an acronym of a loan program. So a lot of these things we saw, the outcomes were from years before of bad actors and bad loans. So that's why we saw those changes happen so dramatically. I do, like you said earlier, I do feel for those people that haven't purchased a home yet. I hope that everyone gets to get to their dreams of buying a home one day. And I do see both sides. I do see that we have an inventory shortage. I don't see inventory drastically coming on the market the same way it did in 07, 08, and 09. I don't see that shift happening because a lot of people are sitting on equity. A lot of people that went into a foreclosure had bought their houses within that first 2 or 3 years before that. Homeowners today have been in their houses for a lot longer because the guidelines to qualify to have a mortgage have been raised, and also the interest rates are so low, someone's not likely to sell unless they really need to.
You mean interest rates are high compared to what they owe right now? You mean what they're paying right now? Yeah.
Yeah,
right.
and it's called an anchoring effect. An
So
anchoring effect where you have this group of homeowners that has interest rates at 3.5%. They're anchored into that lower rate. Until rates drop significantly, they're kind of stuck in that home because it doesn't make sense for them to move unless they have a major life event. So you have an anchoring effect from current homeowners. You have new homeowners trying to get in the marketplace. And unfortunately, the affordability has gone down dramatically in the last 24 months. I mean, 2 years ago at this time, we had rates that were about 2.5% lower than they are today. And every 1% of buying power, every 1% in rate difference is about 11% difference in buying power. So that's been changed by about 30% in the last 2 years.
Right. I mean, yeah, especially you compare rates to saw in 2021 and 2020 at 3%. Now we're at around 7.5%. I mean, that's a giant decrease in buyers' purchasing power. So yeah, I would say that in regards to like 08 versus right now, I would say that if you guys want to see the housing market absolutely crash, you need to see a big imbalance between supply and demand, right? We need to see a giant influx of supply and a huge decrease in demand. That's basic economics 101. If you want to see prices, if anything, fall, you need to see a huge increase of supply and therefore a big decrease in demand. And so I just don't understand how we could get into an environment in which supply absolutely were skyrocketing. The only way I could see that happening is that if the labor market, crashes, or people start losing their jobs left and right, they're not able to even pay their mortgages, and that could increase supply greatly as well. But I think the other caveat to that, and maybe you can touch on this as well, Jim, is that back in 08, I mean, the government just let banks just foreclose on people left and right. There was no real like safeguards regarding that. They just let banks do it. Whereas right now, I mean, we saw that in 2020 where we had the eviction moratorium, the foreclosure moratorium, forbearance, et cetera, that kept people in their houses. And so I wouldn't be surprised if we were to see a huge fallout. Let's just say unemployment were to spike big time. I would not be surprised, and let me know what you guys think about this. I would not be surprised if the government stepped in and opened up a new round of forbearance, some sort of stimulus to keep people in their houses so they don't get foreclosed on. What's your thoughts, Jim?
Yeah, so like you mentioned, in 2008 through 2010, there was a lot of lenders that were bad actors because they were servicing loans for different investors. So for example, just because you make a payment to a certain bank, it does not mean they have the authority or the decision to be able to modify your loan or give you a break. A lot of times back in those timeframes, these loans were being traded so many times that there could be upwards of 10 to 12 investors on each one of these notes or mortgage-backed securities. So you would only know who an investor was if they reached out to you, if you're the bank, to say, hey, didn't receive my payment. That's how crazy it was, because people did not know how many different mortgage pools had certain types of loans in them, and it was really hard to decipher it all. I happened to
Yeah.
be at a bank, the largest bank in the country at the time, to help get the REOs or foreclosures resold to first-time home buyers and people that were on the other side of the equation. So it was a very difficult thing to live through, because I saw on one hand someone lose everything. I saw on the other hand someone get a golden opportunity to hopefully have that property and take care of it and do the right thing. And it was a really difficult thing to live through, especially being a homeowner. We were all affected by that time frame. So I was living it 24 hours a day and felt it on every angle possible.
Yeah.
I would say that the changes that have happened though for these new modifications or forbearances or avoiding foreclosures, they've been really helpful. So for example, during COVID, a lot of banks allowed people to have forbearance. You've talked about that a lot in your shows previously.
Yeah.
Forbearance is a temporary disallowance of payments. That was a really good thing that happened. Every bank was helping people out. When someone's going through a foreclosure or short sale or some type of modification, they're normally given about 30 to 35 different notices to help them make sure they've gotten all the different choices and opportunities to be helped. So it has slowed down the speed of foreclosure, and hopefully a lot of people can stay in their houses and get something worked out with a bank. I am concerned about the pool of money of the adjustable rate mortgages that are coming due right now, because a lot of people that got a 5-1 or a 7-1, which means a 5-year fixed loan with an adjustable or a 7-year fixed with an adjustable, those have all come due, and those normally had caps of how much the increase could go up.
Per year.
A lot
right?
of those caps are being reached right now, which is 5 to 6% over the start rate that they got 6 years ago, something crazy.
Wow.
So if they got a 3% rate, they're maybe fully adjusted at close to 8% right now.
So for those people like who did use an ARM to purchase a home, how are they from the lending side? How are they qualified based on that? Because you get a 5-1 ARM. The teaser rate for 5 years is whatever. It's like 3%. Then it goes up thereafter. So from a lending standpoint, how do you qualify a buyer for that? Because I just worry about, obviously their payments going to increase greatly regardless. But from lending side, how's that work out?
Do you want to know about today's guidelines or
Let's talk about today's versus 08.
Okay.
That'd be a really good comparison there.
All right. So today you have to qualify for the fully amortized rate plus a margin of normally 2. So that's a kind of rule of thumb. So for example,
layman's terms though. So
So for example, if today's rate is 6% on a 5-1 ARM, you have to be qualified at 8% on a principal and interest basis to make sure you qualify for that.
Got it.
That program may be interest only, but either way, you're qualified at 2% principal and interest above whatever rate you're starting with. That's to adjust for payment shock.
Okay. So then if someone did a 5-1 ARM 4 years ago, and they were getting a 3% rate, then you're qualifying them based on a 5% rate, not a 7.5% rate we're seeing today.
Yeah,
right?
Exactly right.
Okay. That's a okay.
That could be trouble, right? That could be trouble. Now, a lot of smart banks that do those loans. So when you think of ARM or adjustable rate mortgages, the banks that do those are normally portfolio banks. The reason why, they lend out money for 1, 2, 3, 5 years on CDs or money markets or savings accounts. And all they're doing is basically leveraging and creating an arbitrage between what they're lending things out for and what they're borrowing money from. So a lot of these loans are portfolio loans. So hopefully banks are smart to do workouts with a lot of these people to give them a chance of really getting into a longer term fixed product. Because if they don't, and they own these loans on their portfolio, every dollar that they lose is $1 less of their assets on their balance sheet. It's a 1-for-1 ratio when it's a portfolio loan.
So how's that work though? If I have a 5-1 ARM, don't know if I want, this is an example, right? So 4 years ago, 3%, I was qualified based on a 5% rate. And then, next year sometime it's going to increase to whatever the rate is. Let's just say it's 7%. So the workout that the lender, let's just talk about this for giving people advice. Maybe if you have a adjustable rate mortgage, how can you negotiate with your lender to get a 30-year fixed rate mortgage that you can afford? Let's just talk about that.
Sure, absolutely. So I'm not a real estate attorney.
Yeah.
I'm not a tax person, I'm a little loan guy. Helps people get home. So the first thing I would do is call the number on my statement. That's the first line of defense. And you want to ask for the loss mitigation department or loan modification department. Those two departments are normally internal. They either represent the bank on their best interests or the investor that owns the note that they're collecting payments for. So that's the first line of defense, is to call them and say, I would like to look at my options to lock in a longer term fixed loan.
Okay. Whoever you pay your payment to.
Exactly. Whoever that is, wherever you get the statement, that's who you start with first. There'll be a phone number on the statement. If you can't get anywhere with that person, call the loan officer that helped you. They should be able to help you also. Get to the right person, I should say.
So
we go back, by the way, to how they qualified for this loan back in 2008, just to make sure people are aware how crazy it was back then and why this is different now. When you had an ARM, let's say you had a pick a payment ARM program. A pick a payment ARM program was one where you could pay a minimum payment that was less than the interest only payment.
Less than the interest only payment?
You could pay the interest only payment, the principal and interest payment, or a principal and interest payment plus more principal. Those are the four options.
What?
When those programs first, in the hottest markets that existed, some of those rates were down to 2% on a pick a payment minimum payment. Guess what some lenders who are no longer in business, guess what qualification number they used for those loans?
The less than interest?
The minimum payment.
Yeah. That is absolutely insane.
Minimum payment.
I didn't know that. Wow.
Yeah. So again, a lot of those banks went out of business overnight. But that's what caused some of the systematic downward spiral, because all these loans were in the same kind of companies. So they got wiped out really quickly. Yeah, so again, negative
amortization. Not paying any principal whatsoever, but you're not even paying the amount of interest. So it's negative amortization, in which each month your loan balance increases. Is that right? Yeah, because you're not even paying the interest. That's insane.
Yep. So again, a lot of those loans have been outlawed in certain parts of the country. And again, negative amortization, it does sound negative. Ironically, some loans it's not a bad thing in some situations. But again, what happened in 2008 and 2009, 2010, a lot of this was an impact of the fact that all these loans went bad very quickly. The banks that had these on their portfolio balance sheets could not support making payments to the investors who maybe bought the note from them, and they were stuck. So that's why we saw such a quick inventory upward spiral of inventory. And again, borrower sentiment is so important in this country. A lot of the economic data that comes out is about consumer confidence. Consumer confidence is a real thing. Like, if people aren't confident that prices are going to be stable, they don't buy. If you look at the Great Depression, they go bury coins in the backyard. That's what they do. So the stability and confidence is so important in what we do. And so I don't see the confidence being eroded to that level again. I just see that, unfortunately, affordability sucks right now. It's not a good situation for anybody.
Yeah, right. Well, let's go back to what you were saying about the negative amortization loans. I know that the share of ARMs back in 05, 08 was extremely high. I think it was around 85% of all loans, if I'm not mistaken, right? And so do you have any idea how prevalent those loans were they're paying interest only, or even less than the amount of interest that they should be paying? How prevalent was that? Do you have any idea?
The main bucket was interest only loans, where you're not chipping away at the principal at all. So those risk factors still stay the same for the investor, right? If I had a $600,000 loan, and
Yep.
paid interest only, same risk for the investor, unless they believe appreciation is still going to be the same levels year over year. So
Crazy.
a lot of people unfortunately got ARMs, and they also did stated income loans.
Right.
Stated income loans were known as liar loans. Stated income loans were really meant for people that were self-employed that had a lot of incoming revenue and outgoing expenses that could not properly document their income. They would show bank statements to show, hey, I can afford this because I'm getting $60,000 of income every month. My expenses are cyclical. Maybe I can't qualify on a traditional 2-year tax return. So that's how this whole stated income thing happened in the beginning. It got way out of control way too quickly when a lot of these companies were able to securitize these debts.
Mm-hmm.
There's a great movie called The Big Short. If you haven't seen
yeah.
any movies about this time frame, you should watch it. It was a house of cards. Some of these mortgage-backed securities pools believe that a loan that had a 610 credit score, along with a loan that had a 580 credit score, somehow equaled a 780 credit score. So it was like a negative times a negative equals a positive, right? In simple math. But not when it comes to, the ability to get repaid on a debt. The history of those borrowers is not strong.
It's just wild to think that a bank would be lending consumers the biggest loan they can get, and then not even asking for support for income and their payments for on their debt. I mean, just wild. Think, how much money do you make? Oh, you make $100,000. Okay, cool. You're approved. It's just absolutely insane.
And there were some lenders out there, even that, unfortunately, there was a document called a 4506T, which is a taxpayer's transcript document that you send to the government. They then send you the tax returns for that borrower. So guess what some lenders weren't even doing? They were not even getting that document, 4506T. Stated income, we don't need that document. It's fine, we don't need it. Like,
that's so crazy.
I mean, it's just not, wow. Sorry, let's get some questions. Let's get some fun
stuff.
Yeah,
Totally. Yeah, I'm sorry for everyone who's watching. We have over 200 people watching for a while
Thank
now.
you, everybody.
So thank you, everyone. We appreciate you. And Jim and I have been talking for a while here, so we'll try to answer some questions. But I just find it to be fascinating, like especially the loose lending requirements from 08 compared to what we're seeing now. Just wild. So question from Monto 008. What is the number of mortgages who did an ARM 5 years ago and did not refinance when mortgages were at the lowest rates in history?
I hope it's not a high number. I truly hope it's not a high number, but I ran across one 2 weeks ago. And obviously I would never talk about anyone's personal stuff because it's confidential, but this individual had a 7-1 ARM. So it had been fixed for 7 years. Was a loan in the jumbo realm, which is above $1 million.
Okay.
Payment spiked up $12,000 a month.
$12,000
a month. The loan was
payment.
The loan was several $1 million, and I was like, "Sir, do you want the good news or bad news?" Whatever, Jim. Give me the bad news first. Bad news is you probably need to sell your house. The good news is you have equity, and you get to live the fight another day. So,
wow.
Sometimes you got to get to the right professionals, get the right answers, make the hard decision to come out stronger on the other side.
That's crazy. So what? I'm just curious why they wouldn't refi when rates are at 3%. But
sometimes people think they're going to be in a house. But it's all about objectives, right? So if you think you're going to be in the house for only 5 years, a 7-1 ARM is not a bad idea because it saves you interest over that period of time. But if a life event happens and you have to change something, that's one of the trade-offs. Long term, short term. So.
Yeah, I know that. So to answer the question, we don't that stat is probably hard to figure out. But I know that looking at the MBA, they look at purchase applications. The share of ARMs has been in the range of 3 to about 10% for a couple of years now. So the share of ARMs right now are relatively low levels, but I don't know what it looked like, 5 years ago. I would imagine 5 years ago, especially like 2 to 4 years ago, the share of ARMs are probably really, really low because we had already had 30-year fixed rates at 3%. So why would you do an ARM? We saw a
Exactly
big
right.
increase.
Yep,
Yeah,
exactly
we saw
right.
a
We
bigger
are
increase of ARMs when rates spiked, right? When rates increased to 7% from 3%, then of course more people are looking at getting an ARM, but that was like 2 years ago.
one of the mindsets people have right now when they're buying. They're either doing a seller 2-1 buy down, which is buying down the rate for 2 years, right? Or they're looking at ARMs again, hoping that rates are going to go lower the next couple of years. So it's a risk, right? People are betting that they're going to get a better rate down the road, and I'd like to see that happen. Unfortunately, there's a lot of data out there suggesting that inflation is still very strong. So.
Yeah, there certainly is. I mean, that's why, like, if the inflation goes up just a teeny bit, like 0.1% higher than the street's forecast, then like rates just shoot up like crazy. It's wild to see that. Johnny Fly, if you're still watching today's video, appreciate you, buddy. Johnny Fly's been a subscriber for a long time. Question, he is not trolling. Doesn't the housing market naturally slow down during an election year? What do you think, Jim? I'm not positive on that one.
There's so many events that are macro events now in the world, with wars, with all kinds of crazy stuff going on. I would have agreed with you in previous election years. I think we're just trying to stabilize the economy at this point in time. I think stabilizing things does trend to slow things down a little bit. So I would believe that inventory levels will probably remain pretty flat this year. I think it will be pretty stable. So nothing crazy, in my opinion.
Yeah, I think that the market, in my opinion, is more impacted by the balance between supply and demand. And normally that doesn't change so much during the election year. And I would look at rates as well. And just there's so many things that impact our market that are, completely beyond our control too. So yeah, hard to say. Let's see other questions here. If you guys have any questions, just put question in caps, and we're going to be ending this at 4:30 sharp. Today. And this is April 30th. You guys are watching today's video. This is a live stream on April 30th, but it will be on my YouTube channel if you guys want to look at this later. Question also from Monoto008. What is the historical impact of unemployment on nominal home prices? We all remember what happened in the GFC, but that's only a single data point. So I would say that when unemployment spikes, we have a lot of people unemployed, and generally tend to see a decrease of buyers and also an increase of housing inventory. That's a kind of the broader picture. How would I answer that? Anything you want to add to that, Jim?
That answers the question, I think.
Right. Here's another question from Kristen. If a borrower had a forbearance during COVID, could they be approved for another forbearance? And that is
great question. I would obviously go back to the lender and ask the question. They possibly could be for another life event. COVID was considered by a lot of people, a lot of lenders, a natural disaster. So on their credit, they were not affected adversely because of the natural disaster category. Some banks had different credit rankings and ratings for that activity. So it would depend on the investor or the bank who owns the note if they're willing to make another modification. I would say most likely yes, because of the fact that COVID was a one-time event, hopefully in our lifetimes. But another life event could happen. You could be disabled. You could have a death in the family, something that happened to you a bank could be working out with you. So definitely reach out to your servicer, aka the person who has your mortgage statement that provides you a statement.
Yeah, and then the forbearance obviously varies by the loan product you have as well. So let's just say you have a forbearance, you had it for 3 months and you exited. There's a set period of time in which you can have a forbearance, but you can re-enter as long as you had not used up your entire period. But lenders, you can negotiate with them and talk about options too. So if we're in forbearance and you're having a hardship, and this is not just directed at Kristen, but anyone, like Jim says, reach out to your loan servicer, which is the company you pay your payment to, and just talk about options. That'd be my best advice for you guys.
And also, it's not a forbearance this time. It'd be a loan modification. So you want to ask about a loan modification.
Why is it not a forbearance anymore?
It's there's just different terms they use. Forbearance is a little bit different. Forbearance is truly used during COVID more than a modification. A modification could be a temporary modification. It could be short-term or long-term. I would just use the word loan modification.
Okay. All right. Tech info. Hey, Jason, you do a great job all the time and bringing great people on the show from Sacramento. Awesome. Appreciate you. Thank you so much. That's awesome.
I was in Sacramento on Sunday. So.
Oh yeah. River Cats game, right?
I was there for three hours and then drove 7 hours home. So it was awesome.
Yeah, it was great to see you. I wave as you're passing the freeway.
Totally.
John Doe, isn't 45% debt to income a very loose lending policy? Thoughts, Jim?
Yes, absolutely. So, John, this is a great question. So I believe in the whole holistic view about doing anything investing. So while it's great to get a house, if you're pushing above a 45 or 43% debt to income ratio, you truly have to think about all the other aspects of what else you could invest in. For example, your 401k and retirement plans. Maybe you can save for college savings have kids and have to do a 529 college savings plan. You got to think about all the other things that you're going to be doing with your money to make sure that you're making the right decision. And I would just make sure that you think about those choices. Anyone should on this podcast or video. Make sure you're looking at all those choices, because if you have nothing in your retirement account and spending 45% of your income to leave nothing behind for a rainy day is probably not a great idea. So,
thank you, Jimmy. Question, David Jacobson. Jason, you just made a video showing the real reason median prices are going up because only the rich are transacting. Not the only reason, but definitely, in my opinion, the mix in sales is impacting that for sure. If only the rich can buy, won't that eventually force a correction? So I don't know, you probably didn't see this video, Jim, but I made a video showing how application numbers for $1 million properties was increasing big time, whereas applications for home loans to buy houses for less than the median sold price, barely increasing. And also we're seeing a lot of data from the Florida Realtors Association as well as the California Association, in which we're seeing a lot more home sales for over $1 million. And also on the national level, increasing by a big increase over 750,000. And that could likely impact overall the national median sold price. And so I made a video about that. Going back to the question, if only the rich can buy, won't that eventually force a correction? I think that my opinion on this regarding will we see a crash, what we need to see in order to see prices decrease greatly, is to see a big imbalance between supply and demand. We need to see supply absolutely skyrocketing. It is increasing. We're up by 30% from last year, which is good, giving more options for home buyers. But overall in Sacramento, we're still seeing multiple bidding wars, even though we have 7.5% rates. But it's not nearly as crazy as 2021, 2022. But going back to your question, in order to see a correction, I would say that the last half of 2022 was a correction. And that was because inventory more than doubled in less than 6 months. Even though we didn't even get close to pre-COVID levels, the rate of inventory growth was absolutely shocking. It shocked the housing market. So in my opinion, we would need to see supply far outpacing demand in order to see another housing market correction like we saw in 2022.
And I would piggyback on that, Jason, for David, around new home starts. I'd also say that price point is much higher than it used to be, because if you're a builder, uncertain about the economic times ahead, potentially, or at least short term, are you going to try to make profit on a $1 million house or try to make profit on a $300,000 house? Unfortunately, builders don't have a lot of incentive to build smaller units because the cost to just put the sticks in the ground is almost six figures, like Jason mentioned on our last
$100,000 in Sacramento just to start building.
So tell me where the margin is. Tell me where you make money. I've seen a lot of comments in the chat too about labor costs, right? Contractors, it's the same price in San Francisco as it is in some rural areas now. It's crazy, urban areas. again, supply and demand, and also where can builders build and feel comfortable. I was at an event last week at the Housing Wire. It's an annual event called The Gathering. They had 4 economists on stage. I stood up, raised my hand, asked the question, do they believe that the federal government will get involved with mandates from builders, maybe give incentives like they give to farmers, like housing aid versus farm aid? Are they going to do things like that? And the answer was potentially down the road, but right now it's really at the state's level, and the jurisdiction starts there. So states need to wake up and do more. I know California is trying to with ADUs and multi-family, multi-generational people on one parcel. Can't say I want to live with my whole family in one place, but maybe that's an answer for some people. We got to get this to a national level. It's, in my opinion, something that's very crucial to stabilizing our housing. That's a big thing for us. So.
Yeah, I think that we definitely need more supply, and that would, in my opinion, the best way to improve affordability is to have more supply. And so you either entice homeowners to sell their houses, or you entice home builders to build more houses. And home builders overall are not building starter homes because there's the margins there are not there. You have a plot of land, you have a set dollar amount for in order to start building, permits and plans and whatnot. And so you either give incentives to home builders, which is a challenging topic given the fact they have record profits or doing very, very well, but they're not building starter homes in general. So it's kind of an issue to say the least. All right, so another question here.
Someone had a good question about El Dorado Hills regarding saturation rates. That'd be a good one to
I was
talk
gonna
about.
get that one too. Let's see here. Yeah, right here. Question. I live in El Dorado Hills. I keep watching all these houses being built in Folsom. Yeah, Russell Ranch and Folsom Ranch is crazy out there. And I see all the plans for move here in El Dorado Hills. Are we at a saturation point yet? So yeah, in Folsom Ranch, this is an area, 15 minutes east of Sacramento. They're building around 10,000 houses where it was just a plot of land, but they're building 10,000 houses out there. But did you have something you want to add regarding this, Jim?
I did. I think saturation is important to think about. It's local. It's hyper local to specific areas. So yes, saturation is important. Ironically, there's still a big flux of people leaving the Bay Area to go to that area. My parents moved there 20 years ago to El Dorado Hills. So very familiar with the area, very familiar with what's going on out there. Again, each market has to think about saturation in terms of units per year and how much can one of those markets sustain, or or can they absorb? Basically, it's an absorption saturation rate. So that would be really good to know about the key data points. That information has obviously been approved already by the county, because the county has reports that they make these builders go through to share why we need more housing. Why should I let you build 10,000 more units? So those data points must be there to support that information.
Yeah, right. I mean, real estate's definitely local, right? So in Folsom, that's the only area really you can build south of Highway 50, whereas the rest of the area is built up. I mean, Jim and I, we used to go four-wheeling where all these houses are built now back in high school.
Yeah, I think I actually drove them. Where my parents live now. It's weird.
Yeah, probably
good
so.
times.
Yeah, definitely. Let's see. We have another question here. For RYU Modem. Question. Hey guys, longtime subscriber Jason. Awesome. Thank you for your support. Can you put together a video or deep dive on the outlook from investors/renters in California? How are rents trending, for example? Yeah, on my channel. Thanks for the suggestion. If anyone else has wants to see more videos regarding that, let me know. My videos tend to be talking about residential real estate sales, inventory, and I don't talk a whole lot about rents. Last time I did that was a long time ago, and the video did not perform well whatsoever. Yeah, if you guys want to see videos regarding rental market and also the outlook for investors and renters in California, let me know. I tend to make 2 videos per month regarding that. But go ahead, Jim.
I'll share one thing for this question. One thing that I would study a lot is Airbnb and short-term rental laws
Yeah.
in the specific areas you're talking about,
Right.
because each county and city have different ordinances around that. Some households are grandfathered in. For example, where I live in Santa Cruz County, in one pocket of the area only has 150 active Airbnbs. So you have to think about those locations, the localities, and what their stance is with short-term rentals and Airbnbs. Other parts of the country are taxing those properties at a higher property tax basis, like in Austin, Texas, and in Nashville, Tennessee. They're actually making them pay a lot more for short-term rentals. So that segment of the market, I would try to stay away from if it was me, because that's going to be the most scrutinized one going forward.
Yeah, the areas in which you're seeing a lot of investors sell, for sure. Jameson, hey Jason, hey, any truth to the silver tsunami theory that eventually all the boomers moving into assisted living, downsizing, or dying will flood the housing market with houses and lower prices? I think there's like virtually, there's so many different theories regarding, if this is going to happen, the housing market is going to crash. I get it. I would say that if all the baby boomers were to die the same week in the US, then that's going to flood a housing market. But the factor in mind, or the factor, I was going to say that people die, they don't die in one single week. Everyone dies eventually, right? But I would say that what I'm trying to say here is that um, people sell their houses due to life events, and often that sometimes is death. But because there's baby boomers, that is not going to cause a housing market crash, in my opinion, unless everyone dies the same week, and that would cause a huge influx of inventory that week, right? But I can't really talk right now. So, Jim, what do you think
I'll
about
take
this?
over. I'll take the baton from you. Yeah, thanks. I believe that there are actually taxation issues with people selling their properties right now. So in California, again, I'm not a real estate attorney, but there's a thing called Prop 19. Prop 19 lets the kids move back into their parents' house as long as it's an owner occupied property to avoid paying long-term capital gains at a really high estate tax level. What this means basically, in certain areas of California and the country, people are incented less to sell the property than they are to move into it. So I think you're going to see people actually, as the silver tsunami comes and goes, you're going to see people ironically probably move back into some of their properties that they grew up in, which is so strange to say, but it might be to
They
their
rent them
taxable
out.
advantage to do that. So that's
Yeah, they
Prop 19. I think we should do a topic on Prop 19 one of these days too, Jason, which is in California specifically, but it's an overall theme of, how you need to look at your parents that own a property and how it can affect you as the heir of that estate, and just learn about the differences there, because that is the new thing in California that people really need to learn about is Prop 19.
No, for sure. That's a good point. Because if someone owns a property for decades, their property taxes in California are going to be super low, because in California, our property tax basis, the amount our tax assessor assesses our properties for, can only increase by 2% per year. So we have a market in which prices were increasing by 15, 20%. Our property taxes were only increasing by 2%. So because of that, over the long term, in general, your property taxes are a lot less. So question, and we're going to wrap this video up in about 5 minutes here, about 8 minutes. Question, supply is up 32% year over year. Yeah, that is significant. I agree this isn't like 2008. It's worse. Affordability drives supply and demand. Unless the Fed pays everyone's mortgages, this is not sustainable. I'm not sure what you mean. What is this? This is not sustainable. I don't know what you mean by this.
Probably the growth rate, everything that's going on with just the trend of appreciation and craziness.
Yeah.
I would ask Fred Daddy, first of all, we need to decipher supply is up 32%. Do you mean new construction supply and resale inventory, or do you mean one
It's
of the
just
other
existing.
categories?
Yeah, that's a
Existing.
Realtor.com's 32%.
Great.
But
Okay.
you look at brand new single family houses, it's very, very high. It's like way high.
Got
I
it.
think
So
the highest level since 2008. But existing houses up by about 32% according to Realtor.com.
I believe you're going to see a migration pattern. A lot of people moving down, downsizing, a lot of empty nesters downsizing closer to being near their grandkids, right? People that can't afford to have their families live in their current community. It's sad. I see where I live in Santa Cruz County. Their kids can't come back from college and even live within a 10-mile radius a lot of times from where their parents grew up, which is nuts. So you're going to see a lot of baby boomers and people migrate to where their kids and grandkids are, and maybe keep their house as a second home or a vacant property. So
Yeah.
I don't think we're going to have it. Affordability sucks. I agree with you, Fred, on that 100%. But again, there are a lot of people sitting on equity. I'm not sure the exact stat of how many people have their houses free and clear, but it's pretty substantial.
Yeah, I think CoreLogic, gosh, what was it? It was less than 5% of people have negative equity in their houses right now.
Yeah, so people have equity. So again, what are the motivations to move? And yes, I agree that affordability is not good, but there are so many people out there that want to find a better place to live, or they don't want to rent. Like, yeah, pay a little more in your mortgage and pay yourself versus pay someone else's rent.
Yeah. Crystal, good to see you. Crystal's been a long time subscriber, so thanks for joining in. Lucky girl, I'm in my 20s. I can confirm my friends in their 20s and 30s have given up on house hunting. We keep getting outbid by $20,000 to sometimes $40,000. And she noted this is actually in Philly. So yeah, I mean, yeah, people cannot afford to buy right now. Yeah, it's wild to see that, the rapid rise in rates, but still in some areas we're seeing, multiple, bidding situations. And we're seeing that in Sacramento as well, which is
so.
wild.
I'll answer that question too a little differently. The buyers that are looking in the market have only really been looking in the market for the most part for like the last 6 months. That's what they know, right? Homeowners know rates of 3, 4, and 5%. Home buyers looking today only know what they've seen in the last 6 months to a year. So it's just where you sit on that side of the equation and perspective is really important. I don't like it either way that rates are high. I don't like it at all. I help families every day, and it's frustrating for sure. So that's difficult.
It is. Coors Light has joined us again. In my Cali town, a 1948 house, 3-bedroom, 1.5 bath, 8,000 square foot lot, sold for $30,000 this week. Sold for $30,000 this week. Do you mean over asking? I don't know any house you can sell for $30,000. Maybe Coors Light, you mean over asking?
Or maybe in 1948, it sold for $30,000. That could be the answer.
Maybe it's that.
Yeah, that sounds like the right answer. Yeah.
Ding, ding, ding. I think, Jimmy, you got that one right, buddy. That's hilarious. Let's see if anyone else has that question here. I think I saw a couple more here, and we'll kind of wrap this video up. So we definitely need to end this at.
We can talk about insurance next time too, Jason. That would be a good one to talk about. Home insurance,
we can talk about that.
What to understand about where you're buying, what home insurance can look like if you're in a fire area, flood area, that kind of stuff.
Yeah, this one here is an improvement to the home insurance situation in California. It's terrible. It's absolutely terrible right now, especially in fire zone. Yeah, absolutely. Total.
Do you know how much I pay for insurance yearly? $13,000 for home insurance.
For in Santa Cruz County?
In the mountains. $13,000 for a house that's worth less than half my house. Yeah, it's crazy. But anyways, hey, I feel bad for anyone who's paying more than they should. So it's just a tough situation we're in.
Yeah, that is nuts. You're paying about 10 times more than me. Question, do you even think a 3% rate would be considered too high at some point in the future based on the history of rates? No, I mean, the environment we had in 2021, where we had all-time record lows for rates at around 3%, there's a lot of factors that impacted that. The Fed was buying mortgage-backed securities like left and right. They decreased the federal funds rate to 0%. So there's a lot of factors that really caused rates to absolutely plummet to all-time record lows. We may not ever see those again unless we have some sort of disaster again. Thoughts, Jim?
No, I don't have any thoughts on that. Rates aren't going to go that low. It's just, that's unfortunately not going to happen. The cost of living has gone up. Inflation has gone up. Core inflation has gone higher. It costs more for a gallon of milk. It costs more for gasoline. It costs more for durable and non-durable goods. And rates going lower would mean those costs would go even higher. than they are. And that would make us all priced out of being able to live, basically.
Yep. All right. Charles has a question. He's almost as strong as me. That's pretty cool. Angel hair pasta over here.
Yeah.
How can you say that people are locked in and won't sell with property taxes and insurance skyrocketing? It varies by the area. So again, California, the maximum amount that our tax assessed value can increase each and every year is only 2%. So over the past, 4 years, home prices increased by about, or not home prices, but the median sold price has increased by about, 39%? But over the past 4 years, my tax assessed value has only increased by 2% each and every year. On top of that, my insurance is exactly the same. I think it's going to increase by 10% this coming year. So my insurance is really low as well. Now, this is much different compared to other areas. I made videos regarding Florida, for example. If you own a condo in Florida, you'll probably see your maintenance costs, your HOAs increase big time, and also your insurance as well. And in some areas, your property taxes can increase to the current market value and no cap on the increases. So that question varies quite a bit depending on the state or the area you're living in. Anything you want to add to that, Jimmy?
No, it's right. I mean, California's unique opportunity to have tax benefits. When you think there are none, there are some actually. And yeah, again, we can do a whole segment on these topics, which would be awesome.
For sure. Yeah. Yeah. I mean, some areas they're definitely impacted by that. And just because you have a 3% rate, I mean, if your insurance is going up by hundreds of dollars per month, and so is your insurance, then you don't necessarily have this lock-in effect that we have in some parts of California, for example. One more minute, and we'll wrap this video up here. Does the refi change tax assessment in California, negating prop? It does not.
No, it's not. It's not refinancing it. Some other states it is. When you refinance, they get new value, and that's sent up to the state or the county to reassess. It is not.
Yeah, that's right. So your tax assessed value does not change if you refi. Oh, my video is slowing down. There's a couple more questions, but we do have to wrap this video up. Everyone who's watching today's video, if you have additional questions, then just leave a comment in the video. This video will be on my channel. Just click on the live tab. You can see our past live streams. So Jim, thank you very much for joining us in today's video. And we have, 250 people still watching today's video. So we appreciate you, each and every one of you. Thank you so much for watching today's video. And we'll see you on the next video.